Dividend stock investing for beginners. What are dividend stocks? Dividend stocks distribute a portion of the company's earning to investors on a regular basis. Most American dividend stocks pay investors a set amount each quarter, and the top ones increase their payment over time. So, investors can build an annuity-like cash stream. Investors can also choose the reverse a dividend if they don't need the stream of income. Here's more about dividends and how they work. Companies that pay dividends tend to be well established, so dividend stocks may also add some stability to your portfolio. That's one reason they are included on our list of low-risk investments. Dividend stocks vs dividend funds. There are two main ways to invest in dividend stocks: through mutual funds such as index funds or exchange-traded funds that hold dividend stocks, or by purchasing individual dividend stocks. Dividend ETFs or index funds offer investors access to a selection of dividend stocks within a single investment. That means with just one transaction, you can own a portfolio of dividend stocks. The fund will then pay out dividend to you on a regular basis, which you can take as income or reinvest. Dividend funds offer the benefits of instant diversification. If one stock held by the fund cuts or suspends its dividend, you can still rely on income from the others. Whether it's through dividend stocks or dividend funds, reinvesting those dividends can greatly enhance your return on investment. Dividend typically increase the return of a stock or dividend fund by a few percentage points. For example, historically, the total annual return, which includes dividends, of the S&P 500 has been, on average, about 2 percentage points higher than the index annual change in value. And that difference can really add up. Using NerdWallet's investment calculator, we can see that a $5,000 investment that grows at 6% annually for 20 years could grow to over $16,000. Bump that up to 8% growth to include dividend, and thus $5,000 could grow to over $24,000. In general, a good rule of thumb is to invest the bulk of your portfolio in index funds for the above reasons, but investing in individual dividend stocks directly has benefits. I thought it requires more work on the part of the investor, the form of research into each stock to ensure it fits into your overall portfolio. Investors who choose individual dividend stock are able to build a customer portfolio that may offer a higher yield than a dividend fund. Expenses can also be lower with dividend stocks, as ETFs and index funds charge an annual fee called an expense ratio to investors. How to invest in dividend stocks. Building a portfolio of individual dividend stocks takes time and effort, but for many investors it's worth it. Here is how to buy a dividend stock. 1. Find a dividend-paying stock. You can screen for stocks that pay dividends on many financial sites, as well as on your online broker's websites. 2. Evaluate the stock. To look under the hood of high dividend stock starts by comparing the dividend yield amount it pays. If a company's dividend yield is much higher than that of similar companies, it could be a red flag. At the very least, it's worth additional research into the company and the safety of the dividend. The look at the stock's payment ratio, which tells you how much of the company's income is going toward dividends. A payment ratio that is too high, generally above 18%, thought it can vary by industry, means the company is putting a large percentage of its income into paying dividends. In some cases, dividends payment ratio can stop 100%, meaning the company may go into debt to pay out dividends. 3. Decide how much stocks you want to buy. You need diversification if you are buying individual stocks. So you will need to determine what percent of your portfolio goes into each stock. For example, you are buying 20 stocks, you could put 5% of your portfolio in each. However, if the stock is riskier, you may want to buy less of it and put more of your money towards safer choices. If you are going to revise your dividends, you will need to recalculate your cost basis, the amount you originally paid to purchase the stock. The number one consideration in buying a dividend stock is the safety of its dividend. Dividend yield over 4% should be carefully scrutinized. Shows over 10% trade firmly into risky territory. Among other things, a too high dividend yield can indicate the payment is unsustainable, or that investors are selling the stock, driving down its share price and increasing the dividend yield as a result. Another thing to keep in mind is that dividend in taxable brokerage account cost tax to be released in the year the dividends occur, unlike stocks that do not pay dividends whose taxation primarily occurs when the stock is sold. For investors with taxable accounts and in high income brokerage, dividend stock may not be as tax efficient as other options. And optimize your stock portfolio. We hope your first stock purchase marked the beginning of a lifelong journey of successful investing. But if things turn difficult, remember that every investor, even Warren Buffett, goes through rough patches. The key to coming out ahead in the long term is to keep your perspective and concentrate on the things that you can control. Market duration aren't among them, but there are a few things in your control. Once you are familiar with the stock purchasing process, take the time to dig into other areas of the investment world. How will mutual funds play a part in your investment story? In addition to a brokerage account, have you set up a retirement account, such as an ERI? Opening a brokerage account and buying stocks is a great first step, but it's really just the beginning of your investment journey.